What's going on, everybody? This is Caleb with Cubic Analytics. It is June 15th at about 1 p.m. Eastern Time. Figured I'd make a quick video today to kind of talk about what I'm seeing in the market as we head into today's Fed policy decision meeting. We should have the announcement coming out here in about an hour, followed by Jerome Powell's press conference. Clearly, there's been, a lot of rhetoric and chatter about doing a 75 basis point rate hike in today's meeting, which could be followed by another 75 bips in July. It's been really interesting to kind of see the acceleration here and expectations for how the market is kind of anticipating Fed policy to move forward. If we recall back to the end of 2021, market participants were expecting between 2 to 3 rate hikes for the entire year, which would basically be a total of 0.75 increase on the federal funds rate. And now all of a sudden here we are in June and we're talking about doing 75 basis points in a single meeting. And so, the markets had just gotten acclimated to maybe doing 50 bips in today's meeting and another 50 in July. There was talk of doing a pause in September. That seems to be totally thrown out the window. So there's just a lot of mayhem going on right now, right? And what we've really seen, particularly over the last 3 weeks or so, is a massive reacceleration in the yields and the dollar after they were pretty much rejected on their prior 2018 highs. We'd seen the dollar get slightly above those 2018 highs, which we're about to go over here in the chart in just a minute. But like I said, the 5-year and 10-year Treasury yields were both rejected on those 2018 highs, had a brief cooling off period after an historic acceleration to the upside. And now we're starting to see another massive acceleration to the upside as markets are starting to price in 75 basis point hikes, maybe even a full percentage point hike. We don't know yet. So real quick here, let's go over the chart of the US dollar index. This is the DXY. We're looking at weekly candles going back to 2006. Generally, we can see some similar structure here. We have this massive consolidation zone, followed by a big breakout, another big consolidation zone for multiple years. And what are we seeing now? A big breakout here to the upside. This was that cooling off period that I was talking about. The DXY fell about 3.3%. And now over the course of the last 3 weeks, like I said, we bottomed and now it's up about 4.1%. Interestingly enough, this morning, as the market's been starting to kind of price in this 75 basis point rate hike today, we actually saw the dollar and yields move lower in the morning session. We can see relative to yesterday's close, the dollar was down as much as 0.8% in the morning, and we've seen a massive rally here to get back into positive territory. As I'm recording this right now, it's up 0.03%. It's obviously not much, but if we look at the intraday climb, I think that's significant for what investors should be looking at because, in my opinion, that means that the markets have fully priced in 75 bips today, potentially in July, and now the focus is really on the rhetoric and the tone, the aggressive tone that Jerome Powell could have in today's press conference. So really quickly here, if we get rid of these lines here, and let's just look quickly at what we're seeing basically since Q4 2020, this is bullish price structure. We have a clear base, a breakout, a retest of those prior highs, and then a massive continuation here to new multi-year highs. We're seeing lower lows this whole way up, even through here, and we're seeing higher highs the whole way up. Higher high, 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 high. We already know we're gonna make a new higher high after this recent breakout in the past few days. So this is really interesting to watch. Why is this happening? We're seeing yields break out of multi-year highs. Let's switch back to weekly candles. We're looking at the 10-year Treasury yield. Massive breakout this week, followed by last week's massive acceleration off that really high CPI print, higher than expected CPI. Again, what we're looking at here is the Fed's prior rate hike cycle. They started in 2015. I don't think the markets really believed that they would go through with it, which is why we still saw yields kind of decline in this area. But then as soon as the market started taking the Fed serious, we saw a big acceleration here in yields. This was the Powell pivot where the Fed shifted back and they paused their tightening schedule, and we saw a big decrease in yields. And then what we see here is COVID, massive QE, massive monetary stimulus, keeping zero interest rates in line. As soon as we started hearing chatter about a potential reversal, about tapering, we saw this big acceleration in Q1 of 2021, cool down period, and then as soon as November hit, the Fed announces tapering, and we've been on a massive acceleration. Since the November announcement, pretty much, the 10-year Treasury yield has increased by 155%. That's nearly 2.5x increase in yields. I know we're starting from a very low baseline, but still, if we just look at the percentage increase, the raw acceleration, that's a drastic acceleration. So that's 10-year Treasury yields. Let's look really quickly at 5-year Treasury yields, and I'll bring up why 5 years are so important. But we basically see the same structure. Fed tightening cycle through here, the pivot in Q4 2018, all the zero interest rate stimulus coming during COVID, and then the market starting to price in the Fed's eventual tightening cycle. We can see here in November when the Fed announced tapering, boom, face rip higher. This is up 221%, 223%. Since November 2021, that was not even 7 months ago. Massive acceleration. We're breaking out above those 2018 highs. And in fact, yields haven't been this high since 2008. What do you know? So basically a sign of the times, right? Now I want to show you really quickly why I'm paying such acute attention to 5-year Treasury yields and to the US dollar. Very quickly, what we can do here is we can add a study and we can compare the DXY, the US dollar index, and let's go ahead and overlay the 5-year Treasury yield on top of this chart. And historically, what we can generally see is that it's really choppy, but they tend to move in line with each other, especially lately, right? And so if we let's look at these periods of drastic monetary intervention, if you will. And so here we have a massive decrease in 5-year yields, followed by a massive decrease in the dollar after the initial panic rush to safety move. This artificially suppressed the dollar relative to other currencies. But as soon as we started to see a sustained turnaround here, what did we start to see as well? We saw a sustained turnaround in 5-year Treasury yields. Let's switch back to daily candles and we can see the acute similarities here. And let's go ahead and remove some of these drawings. I'll bring them back on after this. But this will just help to clear up the chart a little bit. But essentially what we're seeing is 5-year Treasury yields and the US dollar index moving in near perfect lockstep since the beginning of 2021. Why is this the case? As soon as yields go up, we're seeing suppression in asset prices. Yields and asset prices have an inverse correlation. But as soon as the yield that you can earn on a dollar goes up, the dollar is naturally going to have more demand, right? What are we seeing as well? As these yields go up, treasuries getting crushed, stocks getting crushed, crypto getting crushed. The only thing that's going up in this environment are the dollar and commodities. That's for two reasons. A, we have yields naturally rising, and that's because of inflationary pressures and because of the shift in the monetary regime. We're going to an outright tightening cycle where the Fed is raising rates. If the Fed is raising rates, other rates are going to rise. So two main reasons: inflation, monetary policy. As I said, the only beneficiaries of a rising rate regime is the US dollar and commodities. We're seeing that perfectly here with the US dollar, but what we can also do is we can look at commodities really quickly. Let's just pull up crude oil prices. Since 2020, these are also moving in damn near lockstep. We've seen 5-year yields break out to all-time multi-year highs, and we're also seeing crude oil prices at multi-year highs. We still haven't taken out the year-to-date highs, but this is definitely interesting to watch. I think crude oil is still exhibiting bullish behavior, and in an environment where yields are expected to keep rising, I think crude oil is also going to continue to rise. Let's look really quickly at how this relationship has fared in the past. You think there's a correlation here? I definitely think there is. As yields go up or down, crude oil prices tend to move in the same direction. I'm not just cherry picking sample sizes here. Let's look at this. Seems pretty correlated to me. As soon as yields start to move lower, crude oil moving lower drastically. Boom. It's almost as if the crude oil market knew yields, 5-year treasury yields, were about to go on a massive deceleration here. So as we head into the market today, really quickly, let's look at the S&P. It's erased a lot of the early gains that we saw in the beginning of the session. I think even at one point the NASDAQ was up 2%. Let's see, it's at 1.4%. So it's held up relatively well today despite the intraday rally in the dollar. Everything really hinges today on this announcement. Like I said, the market seems to have fully priced in 75 bips. So I think a lot of this is really going to come down to Jerome Powell's press conference, the tone and rhetoric that he has, and any kind of forward guidance that he gives about the expected path of monetary policy going forward. And so, we're seeing asset prices hold up relatively well today, of course, except for Bitcoin. Bitcoin is down 7% in the futures market. That is not good at all. Structurally, this is looking incredibly weak as we come close back to those 2018 highs, right? If we look at the futures market, the day that Bitcoin futures started trading, we're exactly on that level. Again, pivotal here because this also marked the amazing breakout move that led to, essentially, if you bought the breakout from the 2017-18 highs at the end of that week from the peak, you gained 200%. Since then, we've had to fall back down 70%, and now here we are on that same level. So if we break down beneath it, right, let's just say, if we're analyzing the chart objectively, despite what we want to see could happen, in the past, Bitcoin had fallen 85% from that peak to the trough, not even a year later, basically a year later. I don't think we'll fall another 85% from where we are today, but it just shows you this was a pivotal resistance level in the past. It's a pivotal breakout level after that, and now it could act as a pivotal support level. We're not seeing that indication yet. We need to see a reversal here. Otherwise, it's possible we continue to slip. I wouldn't be surprised to see us fall back into that 13 to 14,000 range if we see a sustained decrease below this 20K level. So pay attention there. And I think, today could be the catalyst. The next month here could be the catalyst for that down move or rebound as we see Powell's language and the Fed's policy decision. So generally speaking, I want people to be aware of these dynamics that I'm seeing in the market because I think it's very indicative of overall risk appetite and investor sentiment. We have historically low investor sentiment right now. How can you be surprised? We have bonds just down even more than stocks this year in many cases. We have crypto that's totally been wrecked. I think I saw something that the average DeFi protocol, or it was the top 1,000 crypto on the aggregate are down about 85%. That's a brutal, brutal environment. And investors now are, I think, starting to get to the point of capitulation. I don't know if we're exactly there yet. So, I'm really excited to see how today shakes out. The last thing I'd like to leave people with is really understand that yields and asset prices have an inverse correlation. So as yields rise, asset prices, all else being equal, are going to fall. And that's all based on the net present value function that you learn in entry-level finance and economics courses. So today, as we start to see yields start to rebound, they're still negative on the day across the board, right? But it's really important to watch what's happening in the dollar. The dollar is basically flat on the day, but the dollar is going to be a function of yields. The dollar and yields move together, and typically we see yields / the dollar move inversely to asset prices. So continue to pay attention to yields. I know it's not fun to look at the bond market. I know it's not fun to look at the dollar, but if we want to get fundamental proof of a shift in investor sentiment and the potential direction of the market for risk assets, we need confirmation in the bond market, in yields, and the dollar. Safe trading, folks. Take care.